Yeah, I heard you just talking about how there are a lot of commonalities between the entrepreneurial market here and in China. What would you say are the contrasts and serious differences, say, between Chinese entrepreneurial market, say, West Coast, East Coast? What are the big differences you think?
Between China and Silicon Valley?
Yeah.
The big differences? So in China, entrepreneurs are the same everywhere. So Chinese entrepreneurs, there are lots of young entrepreneurs there, like you guys. They're very motivated. Some of the differences are, in China, a lot of people, they want fast money. They want to see the money, right? In Silicon Valley, a lot of entrepreneurs here kind of just want to see their dream, and they say, oh, I'll figure out the money later. And sometimes that's good and sometimes that's bad. So China tends to be like, where can I make money? The problem with that is that a lot of the biggest ideas out there, you cannot see the money early on. I mean, if you talk to the founders of Google, Larry Page and Sergey Brin, and ask them when they started Google, they thought it was a nonprofit. They thought they were indexing academic papers. They thought they would never make any money. So they would have never pursued that path far enough if they were focused on just how can I make money as fast as possible. That's the downside. So you miss a lot of innovative opportunities by just focusing on the money too early. But at the same time, Chinese entrepreneurs are great. They're like really hardworking. When they see something, they just go at it like crazy. A lot of competition in China, just like here. And in China, investors are different too, so they also shape the market. Investors also want a quick return. So investors in Silicon Valley are much more patient. And I've talked to Chinese entrepreneurs who really want to perfect their product and take their time and not monetize it too quickly. But the investors are like pressuring them, like put in ads, you know, we need to see the money now, right? And they're pushing for exits earlier than we are. So I think it's a cultural difference. And there are lots of differences, but that's one of the primary differences. Others are Chinese. You know, we tend to be a culture defined by individualism. Like people think of themselves as individuals, and they want to do what they believe is right. China is more Asian, and in most Asian countries, it's more of a group mentality. So people really feel more comfortable when they're moving with the group. So that makes it harder for people to break off and do something totally radically different than everybody else. Because the social pressure is much more to stay with the group and do what the group is doing. Whereas here we don't have as much, there is still social pressure to do that in all societies, but to here in the States it's less. You're saying, okay, if you want to go off and do your own crazy thing, even though nobody believes in you, and you can just do it, right? If you really believe in it. So those are some of the differences that I see. And then there's a lot if you go deeper. But you just won, because you're the first bold one to ask a question. We have a Founderspace has a 3-month online accelerator program, and you just won it free. So I'll sign both of you guys up. So you have my card, you email me, and you're in. Okay? Next question. Yeah. These guys just won something. Okay! Might have another winner here.
What kind of insight do you have about developing apps or doing marketing on the WeChat platform?
So WeChat is great. So WeChat, it's right for certain types of apps. It's a consumer platform. It's basically like Facebook, WhatsApp or any of these, but different. They're really more advanced in how WeChat is very well designed. I use it every day now that I'm doing business in China. So there are whole books on how to market on WeChat. It's not a simple thing. But like all social networks, you can share with your friends, but you can also, they have mini apps in there, which is almost like, WeChat wants to keep you in their ecosystem. So they have you can set up interactive websites within WeChat. And then they have the whole commerce piece worked out. So literally, you can just buy and sell stuff without ever leaving the app. And then they have different ways for you to incentivize your users with promotions and all these different things. They have official WeChat accounts. But what I recommend is, they have WeChat here. Have you tried it? Have you downloaded it? So you have that, right?
Yeah, but I can't find anything like AdWords or targeted marketing, anything like that.
Okay, it's just different.
Yeah.
So in the U.S. WeChat, they don't have advertising because I don't think it's big enough for them to have put in ads yet. So they're still trying to grow the U.S. market. But in China, if you look at the Chinese version, they have more advertising. But they don't want blatant. They do put ads, but they're very careful. Much carefuler than Facebook. and they don't really spam you with ads, even in the Chinese version. But a lot of the advertising is done through people sharing stuff and them incentivizing people. So if you set up your official WeChat account and you go to a restaurant or to pay for the restaurant, then they get you to subscribe to their WeChat account, and then they offer you discounts and all sorts of things that way, as opposed to just sticking it in the app. So a lot of it, part of their philosophy is that if it's valuable, people will share it with other people. And so if you can create a reason for them to do that, then you will propagate within WeChat. And Chinese businesses are using it like crazy. Like every time you go in to buy food or anything like that, some of you know, right? They get you to subscribe and try to get you to do all these things. But there's lots of people making lots of money that way. And then WeChat, it's really a payment system. So the QR codes you saw up there, you can buy it. You can go into any store and just buy stuff with your WeChat or Alipay, Alibaba's version. But WeChat is the most powerful because Alibaba doesn't really have a strong social network. So WeChat combines the commerce with the social, which is pretty amazing. But there are whole books on this that you can buy, and they're books in English. I met in China the WeChat marketing expert, and he gives lectures and seminars to foreign corporations all the time that want to launch in China on how to do it. And he was a brilliant guy. Okay, you also want a program.
Oh, really?
Yeah! Any other questions? Okay.
I know we have you, Steve, specializing in IT invest, and we have David in healthcare IT.
Yeah.
How similar is the innovation between those two sectors? Could you?
Between IT and healthcare IT?
Yeah.
IT is, healthcare IT is a subset of IT, right? And it has a lot of particulars about the healthcare industry. There's all these you have to get approvals, FDA, there's a whole process, whether you have a medical device or some new, biotech product. It's its own subset, and selling into the healthcare industry is very tough right now. I mean, you could have the best product in the world, and you could even get approval from the FDA and all these things, but to actually sell into hospitals and doctors, they're overloaded. They're overloaded without anybody pestering them, but now that there are all these startups contacting them, they really are, they can't handle it all, and it's a whole process, and a lot of startups just die along the way. IT in general, it depends what you mean by IT. I mean, they're so different. There's blockchain, right? There's clean tech. There's IoT. There's all these different sectors of IT. Apps and everything else, and all of them have their different challenges and different strategies for going to market. So, and David, did you want to add some more on that?
I'd be happy to. I guess it's okay that I
You
don't.
can grab this microphone. Okay. So David and we have done investing together. He's an incredible investor. Ran Diamondhead venture fund. He's a great guy and he's super nice too, and really wonderful to the startups he works with. So that's just
Well, clearly he doesn't know me well. But, so the question, healthcare and IT sometimes come together. Sometimes it's, if you have a drug or device, then you need to go, at least in the United States, through the FDA process. Then you also have reimbursement. And so that is changing a lot still today. Healthcare IT, a lot of it is moving towards the consumer side, because just as we saw in personal computers, we had individuals adopt them before corporations did, and you'll see, like Fitbit or other sorts of devices, which, probably most of us would say that's some sort of IT, and especially now you can connect it to either your service, or, their service, or connect it to your PC. And so a lot of the innovation from the IT perspective in healthcare will initially come from consumers. And then it will evolve in many different ways. Recently, for someone's EKG, your heart rate, things of that nature, the FDA in the United States just approved a company that had been trying to get approval for several years. So on the back of your cell phone, you put sort of a cover, and it's got 2 leads, and you stick, a finger from each hand on it, and then you can transmit that information to your doctor. So we're just at the very beginning phase of trying to integrate really Internet of Things for healthcare into the whole medical area. But that's going to take a long, long time just because of all the resistance to change.
Yeah, healthcare is a tough area.
It is very, and I've been on the pharmaceutical side, the medical device side, and the IT side for decades, and it's always been difficult.
Yeah, so I tend to lean towards non-healthcare unless it doesn't require FDA approval and selling it to like hospitals. If like it goes directly to consumer, then I get excited, right? If you're going directly to the consumer and you can offer real value in health, then it's easy, or much easier. It's never easy.
And some of the areas, though, that are more fruitful are those companies that are selling to enterprises or corporations.
Yeah, to improve their healthcare, that's another area.
To help them manage, their costs, because you've got large corporations which tend to underwrite their own health insurance. So they want to ensure they get good prices for services and drugs and things of that nature. So that's an area where there's been good uptake, but it's because enterprises are buying it. The other areas we talked about, consumers buying it for their own health. But to try and get involved in hospitals or
That's a real challenge.
yeah, that's really hard.
Yeah. So, you won one too, but you're the last one. The first 3 get one.
But we know there's other good questions
I know.
about it's time. Is it time yet?
It's 7:01.
Okay.
So I think it was perfect.
On the innovation, and also Dave has a few portfolio companies that went public a few, 20, maybe 30 years ago. Thanks for coming. And for that, I think I'll give the partner of this company or this firm a few minutes to talk about their legal practices.
Thank you. Thank you, John. My name is Yao Lisa. I'm the partner of the firm, and thank you for coming. This is actually my second time attending the chain events. And just to give a brief introduction of our roles, we are a global firm with about 2,200 lawyers, and a majority of them are based in the US, but we do have offices in China, in Tokyo, Singapore, and Middle East, Europe, and just almost everywhere. So this office primarily serves the local clients on those, basically startup companies, helping the client to get the fund, and helping the fund to look for the right targets. And we do a lot of IP-related work. Just it happened to be the case because there are a lot of IP coming out of the Silicon Valley. Me myself, I do a lot of work coming out of China. I'm sure that for most of the people here, coming from China, use the WeChat. Tencent is one of my major clients. I do a lot of the patent work for WeChat. And so, I hope that this is a productive event, and thank you for coming. I think I pass the podium to the speaker, Mr. Hoffman.
Okay, great. Thank you. Great. Thank you for having us. Okay, so I'll give you a little lecture now. First, I'll talk about Founderspace and what we do. Oh yeah, 2 mics. What am I doing? It's crazy. I forgot I had this.
Doubling up.
Don't need that, and it's a small group. So those of you in the back, come forward a little. Come on. I want to. Those in the way back, unless you're really shy. Unless you're so shy you can't. But you can come forward. I invite you. I'm a friendly guy. So let me talk about Founderspace, give you a little overview. So my partners and I started Founderspace 6 years ago. I am a startup founder myself. I've done 3 venture-funded startups here in Silicon Valley, founded them, and I started Founderspace to help my friends who are all doing startups, like you guys, people that I knew, really ambitious. They're like, Steve, how do I raise money? How do I go to market? How do I do all these things? And I would connect them. We'd hold what we called roundtables, where we'd all get around the table, and we invited angel investors and lawyers and everybody we need to help them. And that just kept growing. And it kept growing and growing, and then we started our own incubator accelerator here in the US, and now we're a global organization all around the world we're working. And my passion is really working with startups. So I love doing startups. I'm still an entrepreneur. This is my latest company. But I also love working with entrepreneurs because they are the brightest, most interesting people. They have these ideas, and I love going deep with them because when I go deep into their business, I always learn as much as I'm teaching them. So I learn all about their business, and then that helps me with the next business I do. And I've worked with hundreds of entrepreneurs, one-on-one very deeply, and then I've lectured to tens of thousands now around the world. So that's Founderspace. Our headquarters are in San Francisco, so not far from here. And we actually won several, we got ranked pretty highly. So Forbes ranked us the #1 accelerator for overseas startups because we work globally. Inc. magazine put us in the top 10 of all incubators. And Entrepreneur also ranked us #1 for overseas startups, which is our focus, global startup. And all around the world, you see, we have over 50 partners in 22 countries. So we work a lot with European startups and European governments and tech centers and incubators and accelerators. And then we also do a lot of work in Asia. And I know Chain, we do a lot in China. I spend a lot of time there now. We have offices in Shanghai, Beijing, and Wuhan now open. Those are all incubator accelerators. They're open. We're opening up in Chengdu and Shenzhen in the coming months. And then we'll probably spread even further. So I spend actually 70% of my time traveling all around the world, working with startups and stuff. And we also send our instructors all over the world. So we run lots of programs in China, lots in South Korea, Taiwan, Europe. We even did one here in the Caribbean, which was really fun. Get to go to a Caribbean island and work with startups. It was so cool. So I love what we do, and it's been a great experience. And I want to tell you a little about my book. So I wrote this book, Make Elephants Fly, and I went to US publishers and Chinese publishers at the same time. And one of the big differences, you're asking China and the US, China, they do things fast. So even with the translation, US publishers said, it'll take us a year to get this out. That's always, they need a year lead time. I'm like, what is this, an ancient industry? Oh, it's printing, right? Like a year? They're a big publisher, they're Hachette. So they're big global, but they need a year lead time. And China said, we'll get this out right away. Like, you just give it to us, we'll have it translated, and we'll have it out. So it came out early this year in China. It's now a bestseller, and the publisher is Zhongxin, their top business book publisher. So it's huge now in China. And it's just launched in the US. So we had a big party last night at Founderspace. Dave was there, and Youngie was there. Woo, my friends. And we had, over 200 people there. It was great. And so the book is all about basically the past 6 years that I spent working with startups. And I tried to put everything I learned about how startups think, how they innovate, how they problem solve. And I applied that not just to startups, it's good for startups, but for anybody who wants to actually innovate on a product or a service or their business. And the book is what I did in the book that I thought was really important, because I know startup founders, is it's a lot of case studies. So actual examples of companies and showing how they were successful. Like what process did they go through and to actually become successful and break through. And then a lot of case studies of startups that failed, and I show why they failed. So this is the mistakes they made and this. And a lot of it was drawn from my personal experience, working hands-on with startups and doing my own startups. So before I dive into my lecture, I also want to announce Rick over there, which is executive staff. Stand up, Rick. So Rick he works with us. So he's awesome. Executive staff, they do HR for startups. Like all the HR and payroll and everything startups need. They're really cool. And Youngki, you want to stand up? She's a friend. She works with us. She's one of our mentors. And she's Korean. So she's helped build a lot of our relationships in Korea. So if you ever want to do anything in Korea, that's your woman.
If you want to talk within Samsung, just let me know.
Samsung, anything. She's awesome, And we have a huge presence in Korea, and part of it is because of Young. Making some great introductions. So I will start today's lecture, and I have many lectures, but on different topics. But this one is called Innovation Explosion. And, I should tell you now. I have another lecture tomorrow morning at 8:30 at General Assembly in San Francisco. So if you like my talking style now, you just want more. I don't know if you'll be bored, but if you want more, I'm doing a whole thing about the methods for hiring, firing, and inspiring employees. Like how it's really hard, right? How do you get great employees? How do you retain them? How do you talk to them? How do you motivate them? How do you compensate them? How do you get rid of them if they aren't working out? Everything, So I'm doing that tomorrow morning at General Assembly. It's on our website if you go there. But I do a lot of talks on a lot of different subjects. So tonight I'm going to go into think like a startup. So how do you, I know a lot of you are here from different businesses, but how do you really get in the mentality of thinking like a startup? One thing I like to say is dining with death. That's pretty much a startup. If you aren't prepared to sit down and you don't know if the next bite you eat will kill you, that sort of has to be the mentality, because most startups fail. Honestly, I work with 90% or so of startups fail in their initial idea. It doesn't mean they totally fail in their business. A lot of them manage to pivot out of it, but usually the idea you start with is seldom the idea you end up with. I was talking about Google, right? And they pivoted, right? They were in academic research paper indexing, which was a small market. And they pivoted to the biggest market in the world, advertising and search. But if you look at almost every great startup, they have basically dined with death, and some of them have survived and gone on to do great things, and others die. But you have to be fearless. You have to basically say, I don't care if I fail. I don't care if it kills me. I'm just going to do it. Stand out. So one thing you need to do is stand out. There are so many startups out there right now. And I'm an investor, David's an investor, we work with hundreds of investors around the world. They see these pitches over and over. They all look similar. If you look similar to the 5 other companies that have already pitched them, the chance of them investing in you is very small. And so you have to do something to distinguish yourself. Big idea. So most startup founders that I know, almost all of them, their goal is to come up with that great idea that is going to change the world, right? Because that's what everybody tells you. And they don't get going until they have that great idea. And a lot of times, it'll be one guy just sitting there trying to think, or girl, right? Trying to think of the idea. Like, what's this idea? Like, I have to have the great idea before I do it. But let me tell you, that's the wrong way around. Like I said, usually your initial idea is wrong. What you have to understand is that your initial idea for your company is a starting point. It might be an area of interest you have. I actually prefer it when a startup says, I don't have an idea, because a lot of times an idea locks you down, but I have an area of interest I really want to explore. Like I want to really explore how to use new technologies to make factories more efficient. or I really want to explore a new way for people to buy things online. Whatever it is, and then keep your mind open. And the thing I like startups to do is not focus on the idea, but focus on who they want to work with. Because who you work with ends up having a much bigger impact than what idea you had originally. Because if you work with really smart people, really amazing people, and you get along and you kind of gel, then you will figure out if something doesn't work, and you will make it better. And if it does work, great, right? You're already doing it. But if you don't have those people, even if people ask me, would you invest in a startup with great idea, but a poor team, right? Either a solo founder, a team that wasn't great, or a startup with a bad idea, but an incredible team. I'd always choose the incredible team. And I'll tell you what, because the incredible team, if they're incredible, they'll figure out that it's a bad idea pretty fast. And together, they will keep moving until they break through. The idea with the bad team, even if they start with a great idea, they'll probably fail to execute on it. And somebody else will beat them. Because an idea is, like I said, the starting point, then you've got to innovate on top of that, right? The idea is just the beginning. So,
I have a question.
when?
What's your definition of a great team?
Oh, I have a whole nother lecture on that. Well, I can tell it,
Yeah.
right?
1 minute.
So, a little more than 1 minute. So, a great team is, you look at the backgrounds of the startup founders, right? Did they go to a great university? Did they come from Google or Facebook or some, great resume piece? Did they win awards? Those are good early signs. You guys went to MIT, it's a good early sign. But not everybody who goes to MIT they might be great at doing research or thinking, but doesn't mean they're a great entrepreneur. Not everybody who worked at Google is a great entrepreneur. They may be great inside the Google environment. That may be where they thrive, but taken outside, they aren't a natural entrepreneur. So that isn't enough. So when I actually look at them, I look at the background and I credit that, and that's a starting point. But what's even more important to me, who did they bring on their team? Who did they bring on their team when they have no money? Right? When they're just beginning, and all they have is their ability to convince great people who could have gotten a job at Google or Facebook for 6 figures to not take those jobs and actually join them in their vision. Because at the end of the day, like I said, teams, the most important thing a CEO can do, the most important thing, is build the team. And that's why Google's done so well. They are obsessed with bringing on great talent. And they have a whole process at Google for vetting talent that they develop. And Larry Page and Sergey Brin were so obsessed that when Google even had hundreds of employees, they would interview every employee, from the receptionist to every single person in the company. They would personally interview because they felt everybody has to be great on our team. Everybody. And there's some books out on this that you can read. It's really important. So if I see the CEO has the ability to pick great team members, motivate them, bring them on their team, then that's a good first sign. Before they even have a product, before they even have traction, before they have customers, that's a good sign. Then of course I look at all the other things. It's a really quick answer. So a lot of innovating, right, when you're first starting out, is a lot of people think of a big idea, right? I want to change the world. I want to do something huge. But a lot of times, that's fine. And sometimes if you're Elon Musk, it works. But most startups, they aren't Elon Musk, and they don't have the resources or the clout or anything to do a huge idea. So a lot of times, starting with something small and then seeing what happens is a better way to innovate. And I would say the majority of startups that actually become these huge unicorns actually started pretty small. I'll give you a couple examples. So we all know YouTube. So YouTube started out as a video dating site. And everybody knows we all love to video date, right? No, nobody likes it, right? Nobody wants, and they found that out. People were going on their site, they thought it was so cool, this is the early days, and people didn't want to date on video. It's embarrassing, it's awkward, how do you do it, People much preferred to post a profile, perfect it, and then keep iterating on their profile until they get dates, or now Tinder, right? But video dating failed. So what did they do? They actually did something very small that turned them into YouTube. They wanted to share a video of their party, of a party they had with all their friends. And they're like, oh, we built this video dating site that makes it easy to upload videos. We'll just upload our video to our video dating site and share the link. And then all their friends started sharing this video. And they're like, wow, this is so easy. There's something here. Like, it's a little thing. It's link sharing. So YouTube, they weren't like, we're going to build the biggest broadcast network in the world and totally change, video online. That wasn't their idea. Their idea was to simply share one video with a friend. And how do we do that? Through this simple mechanism of sharing a link to a page with Flash on it where the people could watch the video. And then they figured out that worked. They started sharing it with all these other people, and people needed that, right? They were like, oh, we need this. And then it just spread like crazy, virally, because they were at the right time with the right thing, and it was simple link sharing. Once all the videos started to get uploaded to YouTube, well, then it became a repository for videos. Then it became the broadcast network. But that was almost an after effect of what their initial idea was. Most great startups start up very simple. And I could give you 20 examples, but we're constrained for time. So I'll move on. Small teams. There's a reason that big corporations tend not to innovate well, because most of them, they just bring in too many people, too many executives. But you look at the companies that innovate well, like Amazon, like Google, they let it start from the ground up with really small teams, just like startups do. So having few people on your team does a number of things. One, it makes it more egalitarian. Everybody is equal. There's not this hierarchy. When you have a small group of like 4 or 5 people, which is sort of ideal, at the beginning everybody's the same. Everybody's idea counts. People are more open in that environment. It doesn't have the hierarchical structures. The bigger the team gets, the more hierarchical they naturally become, because you need people to manage and all these sorts of things. So the longer you can stay small, the better. I actually tell startups, hire reluctantly at first. Like really, it's good to have, a good number is under 10, because under 10 you can move fast, you can change fast, nobody needs to have titles, everybody does what needs to get done. It's very fluid. You start to get over 10, and then you start to having to assign people stuff and have different, gets more bureaucratic. You don't want to do that. You want to keep as small as possible. Like AngelList, when they were growing like crazy, those guys, they were like the biggest angel site in the world, and they had like 15 people. And Craigslist, too. They kept their companies very small. Now, AngelList is bigger now, but they went a long time without going over that magic number of like 15. And Craigslist, they sort of dropped the ball, in my opinion. But they did stay small for a long time, and they were growing like crazy. So you can keep small. Actually, my own experience in my own startups is that when I had a smaller team, we'd often move faster than a larger team. Because the other engineers didn't have to manage other engineers. Everybody's hands-on. Engage your team. So the other thing you want to do early when you're in a startup or a corporation that's innovating is you want to have a lot of people think like, oh, it's the CEO's job or the manager's job to come up with all the ideas, to tell everybody what to do. But the companies that really innovate, they have every single person on the team, everybody, part of the innovation process. They tell everybody, it's like, we don't care what job you have, it's everybody's job to make our business better. I want you to innovate on marketing, which is growth hacking. We call it growth hacking. I want you to innovate on the product. I want you to innovate on sales. I don't care what you do, whether you're an engineer or not. If we're testing product market fit and going out to the customers, I don't want my engineers sitting there coding. You guys, if we haven't figured out a product market fit that we know works, everybody should be focused on product market fit. Because whatever you're coding now, if we haven't figured out that the customer really wants this product, it's the wrong thing. You're coding the wrong thing. You think you're being productive, but you're actually not being productive. You want to code and do all at a minimum level and get out of the company and start to get all the data pulled into the company. And you want your whole team engaged in that. Small scope. So keeping the scope as narrow as possible at the beginning allows for much more flexibility. If you have big scope, it takes you a long time to iterate, a long time to make changes, a long time to run what we call experiments, testing out your hypotheses on whether it works. So keeping your scope small allows you to try something out, it's isolated, it works or it doesn't. And And I will tell you, as a fact, almost every great company out there was built from a product that is so simple. Like the core idea, if you strip away everything else, the core idea was very simple and they could test it and then it just took off. Because people really wanted that. Adding other features and other things, it never makes a difference. I made this mistake. I've developed lots of products, lots of games, lots of web apps, lots of things. And I used to think, wow, if we just add this extra feature, if we just make this change, then the customer will love it. It never happens that way. You're better off scrapping the whole thing, going down to the essence. What is the one thing we think our customer really needs? And that's all you build. It's really, this is key. I can't emphasize this enough. You know who learned this? Instagram. So Instagram's original app was called Bourbon because they like to drink bourbon. And Bourbon was a complete social network, a mobile social network, ahead of its time, right? With all the features of a social network and all these things. And you know what? The Instagram guys are super smart. They started measuring what people, their network was going like this, you know? And growing gradually. And they started to measure, well, what are people really doing? Well, they're actually not taking advantage of most of the features of our social network. The one feature they really seem to love, there are two features they love. So one feature was filters. They thought the filters were really cool in the photos. And two was sharing their photos on another network, Facebook. So they were like, oh, these are the only two things they seem to really, really care about. We'll strip everything away, we'll launch a new app called Instagram with these two features, and boom. What the same features they had in their bigger app, it was killing them because customers were confused, they didn't know what to do, they weren't really engaged. And as soon as you made it very clear and focused, narrowed the scope, the customers focus, oh, this is what you do. You share on Facebook and you take cool pictures, you can put filters on it. They understood it. So that's another thing to keep in mind. Small budgets. One of the great things is when you are resource constrained. Meaning you don't have too much resources. We've seen it over and over again in big corporations. They shovel money, and then you know what happens? Or VCs, they come into startups too early, and they give them too much money. David's nodding his head. And you know what the startups do? As soon as you get money, you're under pressure to spend it. You feel like, man, they can't give me this money, and I just sit on it. So you start hiring people. And then again, your team gets bigger. And once you hire people, you have to give them something to do. So you have to lock everything down, you have to have a plan, you have to have, structure. And at the beginning, when you're innovating, you don't want a plan. You don't want a long-term plan. You don't want structure, you don't want a lot of people there. So too much money has killed many, many startups. It has stopped them from innovating, stopped them from being flexible. They started to scale their business before they had a product market fit. And scaling before you have a product market fit, there's almost no surer way to go off a cliff than that. Small time. I think having time constraints is important too. The whole process of innovation is called the iteration cycle. How fast can you come up with an idea to test that will move you to the next level of understanding, gather data, put it out there, engage customers, get the feedback, incorporate the changes, and then do another test. That's the iteration cycle. Great companies want to compress this cycle down to like 2 weeks. So the faster you can make this iteration cycle, the more you are learning. And we all know doing a startup is a race. Because whatever idea you have now, I can guarantee you, there's 10 other people out there with exactly the same idea working on it at the same time. So they are going to be working on it, and the one to figure it out the right way first captures the market. Big opportunity. So when you do this whole process that I talked to, along the way, you'll always keep your eyes open for the big opportunity. And it may not be that big idea you thought of at the beginning. It may be something totally different. Like for Groupon, it was totally different. Groupon was basically, the idea was kind of like a nonprofit social do-good site. And then somebody got on their site to recruit other people to do social do-good. And their idea on Groupon, their idea on the original site was called The Point, the original site of the founder of Groupon, Andrew Mason. So The Point was, they were on The Point and you create projects and recruit people to do them. His idea was to recruit people to get group discounts. And Andrew Mason, the founder and CEO of Groupon, he wanted to kill that. He was like, this is not what we're about. We are not about being commercial. We are about like doing good in society. This is not the point of the point. I want to kill this. But his investor was, more of a businessman, and his investor was like, wait a second, let these guys do what they're doing. They're doing something interesting. We're not making any money on this site. Like, it's not, not much is happening. These guys are, let's do it. And he resisted for the longest time until the meltdown, and like the 2008 meltdown. And then the investor came in and goes, I'm not giving you any money and nobody else will, in what direction you're going. Pay attention to this. And he paid attention, and boom, and they renamed it Groupon. It just took off really fast, and went public. So the idea is you want to look for that big opportunity. You might be doing something that you believe is the right thing, but that big opportunity could be lurking just under the surface. With Yelp and other companies, what they originally started out with wasn't Yelp. The whole user reviews was a side thing, and that became the central feature once they found out people really wanted to write reviews. They didn't think people would. Challenge your beliefs. So a great way to innovate if you are a startup, I really recommend this, is whatever industry you're in, write down everything you believe to be true about it. Everything. Like make a list of everybody in your team. What do we think is absolutely true about our industry? Write it down. And then go through that list and say, is this really true? Is it really true? With new technology, can we change the equation here? Can we do it differently? And as soon as you start to think deeply about these things, you'll see a path to actually doing something that nobody has thought of. Think deeply. This is another thing that is probably the hardest thing I'm going to ask you to do today. The number one hardest thing. And that is, we're all very busy. Could you take 2 hours a week, turn off your phone, turn off your computer, turn off everything, and just sit there and think about your business? For 2 hours. You would be surprised at the ideas that come into your head. Because none of us, 2 hours a week isn't a lot, is it? But who sits there for 2 hours a week and just thinks about the business? Raise your hand. Do you?
No.
Okay. I was going to be impressed.
A little bit. But after 2 minutes, I fell asleep.
Oh, yeah. Well, then your business must be pretty darn boring, or you really don't care about it, okay? So I'm just saying, if you want to innovate, if you want to come up with something that people haven't done, this is a great way. And it isn't easy, because it could be boring, but you have to train yourself. It's like meditation or any of these other things. It's not something you'll just do perfectly the first time, but I think you will be very surprised. Just do it on a plane next time, okay? You're on a plane, don't watch that movie, don't pull out my book and read my book. Just sit there and think about your business. And you may come up with something, you may be amazed. Get dirty. So I like to say, do not sit in your co-working space or in your dorm room or in your wherever you are, your office, trying to innovate. Get outside, right? Go out into the world and actually immerse yourself in what your customers do. Say, hey, can I hang out in your office every day for a week? I want to help make our product better for you, right? I want to help provide better service to you. You'd be surprised. Some of your customers will say, sure, right? Hang out for a week in our space, see what we do. And then go there, right? And start to observe what they do. I say shut up and observe. Because what you don't want to do is go into their workplace and start telling them what to do. Telling them how great your solution is. Your actual job as a startup founder is to be like a fly on the wall. To be invisible. To just sit there and look at what they do. What frustrates them? What is the thing that drives them crazy? Where do they spend a lot of time and effort where they don't have to? What do they value? What in their business do they think is really important that they could that they can pull in, right? Is it the revenue from their company? Is it relationships? Is it something else in their business? Is it efficiency? These are all areas that are open for you to innovate on. And you won't have these ideas unless you're sitting there with them, looking at their business through their eyes, right? So you don't want to see it through your eyes. You want to be involved enough in their business so you start to understand what they think. Because most startup founders, they're building the wrong solution to the wrong problem, right? They think it's a problem, but the people and the customers don't think it's a problem, or they don't think it's really valuable. And unless you figure that out, you aren't going to break through. Use new technology. So this is the beauty of technology. Technology, if you're a startup, I always say, look at the very latest technology. Why do I say that? Because every time a new technology emerges, every time, depending on the type of technology, it suddenly changes the playing field. It changes how things are. And good technology will not make a good business. The technology itself, when I look at a startup, I don't even care what technology they have. But I do care how they use the technology. And the idea is that new technology, when a technology first comes into the market, like the mobile phone, think of all the products and services we have now with a mobile phone. If you were at the very beginning of mobile, when the iPhone first came out, right, the first smartphone, that was really amazing, you could build practically anything, and you would have a chance at a huge business, as we see now. Every time a new technology emerges, what it does is it suddenly opens up all these doors, right? All of these doors are open. And as an entrepreneur, what you want to do is take that technology and go through one of those doors and build your business. And by being the first through that door, you have a huge competitive advantage. Because everybody who's doing everything on mobile suddenly had a huge advantage to people who were doing it just on the web. And if you look at the generation before that, the people on the web had a huge advantage to people not on the internet, like Amazon, right? And if you look at before that, the people who were using computers first had a huge advantage over those not using computers. So now, like the new technology waves that are coming, blockchain, people are figuring that out now. AI, big data, there are all these technologies out there now that people are using in interesting ways. The technologies don't matter except in the fact that they're new and they're opening doors. Run experiments. So when you get these new technologies out there, your job is to figure out how to create an experiment where you can gather data and figure out if there's real demand. I have a rule, and it's a rule that you all should think of. A startup never creates demand. If a startup tells me I'm going to create demand for this, they will always fail. What startups do is they actually figure out where the demand is, and they tap that demand. So what you need to do is think in those terms. There's demand out there for things. People don't even know what they want until you show them a lot of times. But the demand is there. Like Steve Jobs didn't create demand for the iPhone. He didn't create demand for the iPod. There was a demand out there already. He figured out that there was a demand, and then he created the product that they really wanted to meet that demand. That's what you need to do as an entrepreneur. And you do that by running many, many, many experiments, testing that. Is the demand there? Is the idea I have right now, is there a market for that? And if you talk to Steve Jobs, he will tell you, I didn't talk to customers at all. I just created what I wanted. But that's not exactly fair, because Steve Jobs knew there was demand there. Before the iPod, it wasn't the first MP3 player. There was a big demand for MP3 players before that. The demand was already there, but he created a much exponentially better product to meet that demand and opened up a whole new market. iPhone, there were already smartphones before the iPhone. Many of them, the Palm, many others. But what he did, Steve Jobs, is he took it up a whole new level. Like, it wasn't incrementally better. It was 2, 3, 5 times better than everything that came before it, but he met the demand that was already there. Watch what happens. Once you need to be very data-driven. So the great startups out there aren't shooting randomly. It isn't like just luck. When they run their experiments on the demand, they really know how to analyze the data. Really important for you. And also, because we're running out of time, don't chase losers. So don't run after, if you put your idea out there and there isn't demand, don't keep going after it. Don't thinking that if I change this, if I make it incrementally better, suddenly the demand will appear. I've never seen it happen, right? People just try to make it and they just keep going. I did this as a startup founder. And I learned the hard way. right? I just like, man, if I just like add another feature, if I just change this or that, if the core demand isn't there, it isn't there and it won't materialize. One winner. So this is the end of my talk, and I just want to say, you can fail many, many, many times, but in your lifetime, all you really need is one winner. I mean, how much money do any of us need, right? I mean, we should be doing this because we love doing it. And so remember that it's okay to try many things and have them not work, and you never really fail unless you stop trying and stop learning. And the best thing you can do is that say, after everything you do, whether it works out or not, what did I learn? And really reflect on that. That is what has helped me personally the most. I am going to let now David do his talk. Well, I guess we're going to talk together, right, David?
We are.
Okay, and I'm going to interview
You
him.
know, I've had the pleasure of listening to many of his talks. They're awesome, don't you guys think? Let's give them a round of applause. When you start companies, of which I fund, either through my fund or personally, you know, a couple people with a dog, sometimes there's not a dog. Sometimes there's one person, but I hope there's more than one based on Steve's comments. You want to be able to see that someone's semi-social and can convince one person to join, you know, him or her. I mean, Steve has huge wisdom.
You're too nice to me.
Oh, no, I'm honest, I'm really honest, and I've seen, you know, I've been to a lot of accelerators and incubators and things like that, and Steve has a real gift to take complex subjects and really make them explainable. And so when you look at what he presented today, very powerful. Now, a lot of his comments are geared towards entrepreneurs who are starting out, but then there's also companies evolve over time. And just to get a sense for all of you, how many of you are in a company with 10 people or less?
Okay.
Okay, that's a good number. And then how many of you are with really large companies?
Okay.
Okay,
So you got a
so-
good mix.
Yeah, good mix. And how many of you have ever started a company in the past? Let me see hands.
Good.
Okay, wow, that's close to 50%. How many of you plan to start a company in the future? Wow, okay, that's great. This is my type of group.
Yeah.
They're lots.
So let me ask you some questions.
Okay.
Because I want to shift the spotlight.
Okay,
Okay.
okay.
So David, you know, you've run venture funds. He ran the Harvard endowment.
I started a venture fund.
Yeah.
Entrepreneur through that aspect, as well as starting some companies along the way, many times being first capital into companies. So I just love
So tell
what
me,
you're saying.
just quickly, start with your background.
Yeah, so how many people do you know were born in Hollywood, California with movie stars? Oh, no one. That's me. That's me, guys. I used to go to school with movie stars. It was really crazy, but it was kind of fun. And then, so I did that. I have a bachelor's in electrical engineering from USC. I eventually made my way to Harvard University to get my MBA. I worked for Hughes Aircraft Company on missile projects as an engineer. Decided I was not so good as an engineer, so I went to sales for IBM, which was super cool because at that point in time, it was considered the best company in the world. But then I saw how large companies work, and you talk about politics and other things, and I said, oh, this is just so hard, everything. I have to go to the opposite side. So then I worked for Harvard's endowment, investing in all sorts of different businesses in the private markets. We managed a couple $2 billion in my group, so I helped manage that along with a few other people. And then I said, well, why don't I go start something new? So I went and started a new venture fund called Diamondhead Ventures. It's $140 million of capital, but then it's always, all of us need to reinvent ourselves, right? And so I continue to try and do different things in different ways with different people. But the great thing is, I seek out awesome people who are interesting because they tend to do something special. Either they're like a pipe piper and can bring everybody else along in trying to get them, in getting people to join them, or they're crazy and they come up with crazy ideas. Because my strong belief is that the crazier the better, right? You have to be unconventional. You have to look at a situation and say, things have changed. But then you have to be insightful enough. You have to shut up and listen to customers or to others. Because the great entrepreneurs are probably the best listeners in the world. And they really try and get inside of people's heads, get inside of companies, get inside of markets, and come from within to listen, and then try out different solutions. And then, you know, what a lot of venture people don't tell you about is we want to invest in unfair situations, right? Where you have a competitive advantage, you have something that's unique. That means you're going to win. And so, after a while, I've been doing this for 30 years, I know I look like I'm only 30. But no, you start to understand how not only the phases of companies, what they progress through, all the way through IPO, and I've had the good fortune to be participants in that. But the reality is, especially today, you don't have a lot of companies that go all the way to IPO. You know, the vast majority of companies are bought through an acquisition. And you work with great firms, law firms like this, which can help you in that regard. But you always want to have a large enough opportunity where you can take it all the way to being public. And actually, for a venture capitalist, people consider an IPO being the greatest thing since sliced bread, right? But it's actually not. It's really just a financing activity for companies. And speaking of financing, when we invest in companies, and this is even angel investors or institutional venture capitalists, each financing round we say, okay, here are the key risks in the business. What can we do to take several risks off the table so that when we go to look for more capital, we'll get a higher valuation and we'll be able to raise more money, right? So it's all about risk reward. That's how we build companies. So if you have a product and you get into a market, and you're just starting to sell and you have some traction, then I might go to the CEOs with whom I work and say, okay, how do we grow sales and marketing without having to hire 100 people? Because it's really hard to hire A+ people, right? And certain businesses lend themselves to being viral. So it might be buying keywords or things of that nature. In the enterprise side, if you're selling, you need credibility. And so I love to borrow credibility of partners, right? So if you have corporate partners who can go and represent you, you borrow their credibility, right? When we build companies, for those of you who have smaller companies, how many of you have great advisors, right? Did you guys have great advisors? Okay, our team from MIT. When you go out to raise capital, I hope that you put their names out there, right? Or if you have corporate partners, maybe from a technology sharing or from a distribution or some sort of relationship, you borrow their credibility. And it's like, I just personally put money in a guy who created a company. It was him and a few other people, but their first customer is Salesforce. Now, if that's your first customer is Salesforce, that's pretty killer, right? Because most people regard Salesforce.com, now just Salesforce, as one of the premier, most innovative IT companies in the world, right? And their product, in fact, it's not even just Salesforce. They first went to IT, and the IT group bought their solution. Then it jumped over to marketing, and so now marketing is using this solution. So they have a pretty good story for land and expand, not just in the IT group, right, which has lots of different departments, but also in all their marketing organizations. So you kind of get excited by a story by that.
So why don't, I want to ask you a few questions.
Awesome.
So when you first meet a startup and are looking at it, what are the most important factors? The 3 top things you look at.
Yeah, so it all depends. I'll give you a couple answers, and it depends on the stage of the company. Okay, so I'll put the broad venture capital hat on right now. If you're an early stage company, typically just a few people, I go back to Steve's comments. There are people who probably come from that industry. Because when you spend time in that industry, you know the pain points. You can speak to them. Also, when you want to go get a customer, you probably know some of the potential customers. Because if you're smart enough, you actually go and you work with potential customers while you're refining your product concept. They're going to help you create a solution. Now you got to make sure you don't have one customer and they just tell you one solution, because it may be a one-off. You don't want to do that, right? So you have to go to multiple customers. And so when they come in and they see me and they say, you know, I've got this concept. If they already have product in the market or they're pretty close, I'm going to ask them, tell me, who are you working with, right? And then many times, they'll even go to companies who want to distribute their product. And these distributors, resellers, partners, it'll be like, if you build that, you know, we've got a ton of other customers we'd love to take it to, right? So, again, thinking about it in that way, talking to them, making sure that at least from my years of experience, what they want to do, is it logical or not? Now, I have to tell you, I'm only going to invest in certain areas that I know. So we were talking a little bit about the medical world. And if a biotech company comes in to see me, I'll tell you a couple things about that entrepreneur. One is they don't do their homework, because I don't make biotech investments. Okay? So what are they doing even contacting me? It shows they're clueless, right? But I'll tell you, on the other hand, I look for discontinuities in the marketplace where you're blending multiple disciplines. So for instance, I provided the initial capital for a company that's using big data to come up with designer drugs, personalized medicine for cancer patients. So they've gone on to raise some venture money. In total, they've probably raised about $15 million, right? And I provided them the initial check. I met the entrepreneurs once, and I said, I'm in. And they said, well, we don't even have a company yet. I said, that's okay, set up the company and then I'm in, right? But you find people when you've been doing this for a while and you go like, they have the skill set. So it was a husband and wife team. The husband was from the algorithmic big data side. The wife was from the pharmaceutical side. And I've been looking for something like that, because I believe that great opportunities are at the boundaries of different industries, right? Because the opportunity won't be obvious to most people. But that's okay, especially if you want to invest in an early stage company. I'm looking for discontinuities in the marketplace. And if I can't give you 3 or 4 discontinuities, either I don't understand your business, or you're not doing a very good job of explaining it to me. So one is the team, right? And Steve talked about that. You know, and it's really a vision, because we don't know exactly what the product is going to be, but we know kind of the pain point. They should be able to describe it well. And then they should, you know, have an idea about who their partners, their customers. Many times, recently with another company, the founder had a consulting business, and he wanted to go in and create some IT solutions. So he had spent really the last 10 years providing software solutions to enterprises, and he wanted to start something new, and so he had been working on this product that he was using for his customers, in particular over the last 4 years. So you think about that. Many customers knew the pain point, came to me. I understood his market space because about 20 years ago, I invested in a similar type company in Web 1.0. And again, go back to that pattern matching. If you've been in the venture business for a while, or you've been an entrepreneur and hopefully successful, and now you're on the funding side, they're going to look for companies that many times they can relate to, right? They're not going to invest in that biotech company in general. It's going to be something that they've done. So I hope I didn't take too long, but that's trying to throw different stories in there. Let me say one other thing, though, is there's phases of companies, right? And I'll contrast too. We talked about the real early stage, which is really a bet on people, and that they're going to be smart enough to find a really big opportunity. Because venture capitalists only invest in really big opportunities. Another session would be, why do venture capitalists have to only bet on billion-dollar-plus companies? But it has to do when you manage a lot of money, and you want to return a lot of money, a multiple of what your investors give you, they have to be very large companies. I'll contrast the early stage then to the late stage investor. Late stage investors start to run off financials because the team's pretty much set, the vision is already being implemented, there's lots of customers, sometimes hundreds of customers, sometimes thousands of customers. If you're a social, consumer-oriented company, you have millions of customers, right? And you can see what the business model is, you know what the customer acquisition costs are, you know what your gross margins are, et cetera. And typically you're raising capital to grow more quickly. Because many of those companies could be profitable if they slowed down their sales and marketing. So that's sort of the balance you use when when we think about companies is, when could they get profitable? And at that point in time, if you become profitable, you control your own destiny. Because you can't go out of business if you're generating cash. But the other conversation I have with entrepreneurs, if you want to get involved in the venture business, typically you're going to grow big or you explode, and it's the Death Star collapsing or something. I mean, I'm not sure what it is, but it's not it's a painful death. It really is. And entrepreneurs have to understand, venture capitalists are there to build something big because we have a lot of losses. So we have to make up for those losses. And when you build a multi-billion-dollar company, one of my investments, $5 million in, over $300 million out, right? But I didn't own 100% of the company. So that's where, if you invest in a concept as a venture capitalist, especially early stage, it can be very profitable. But that's one investment out of a whole portfolio. And that one investment generates the returns. for a successful fund. You'll have some other investments that might return 2, 3, 4 times, but it's that 10 to 100x that the venture capitalists are really looking for.
So this is innovation to IPO. So when you have a startup, how do you know when, let's say an acquisition comes along, an acquisition offer, and you've been in this position, whether you take that offer or whether you let the startup keep running towards an IPO? How do you determine that?
And that's a great question, because that's not always obvious.
Yeah.
You know, and it goes back to risk reward. Venture capitalists tend to think about, okay, what's a terminal value or exit value or eventual, how much can you eventually get out of this company, right? How much is the whole company worth, and then what's my % ownership worth? And you have risks that you're trying to take off the table as quickly as you can as you do these financings. And what's important is for investors and board members to gain agreement on what the risks are and the probability of them playing out in a positive way. And so, you know, I've been in situations where companies scaling nicely, you know, the revenues are growing, everything feels good, but then they might just have one customer. Now, what if that customer decides they're not interested, what if the customer decides they're going to go a different path, right? Apple does this periodically, and I guess with Qualcomm, from a chip standpoint, you know, huge revenues for Qualcomm, but they got into a spat. Now, imagine if Qualcomm only had one customer. It's a huge risk item. And that is true of some companies, right? Where they grow quickly and they're dependent on just 1, 2, or 3 companies. And if an offer comes along and it's, you know, above where you thought you might exit the company, you have to talk collectively, because venture capitalists only own a certain percentage of the company. The other reality is if management doesn't want to sell, the company won't be sold. Because typically, at least part of the management team has to go along with the company. Otherwise, the transition is really hard. The acquiring company thinks they're getting something that's broken. So it's really the entrepreneurs, or at that point in time, most likely the CEO and the senior executive team that makes the decision. And this is where, you know, you constantly have to have a dialogue about, okay, what are the risk items in our business? We can see what's going well. Who do we need to recruit? Because there's also many times I've seen CEOs be able to take a company to a certain level. And to go beyond that is very difficult. It's not in their skill set or their interests or whatever. And so when that occurs, to make a CEO change, that's hard. You have to get the right person. The current CEO has to be on board with it. The senior executive team has to be on board with a transition of management. And if you're not able to make a good transition, an easy transition, you could blow up the company.
Yeah, the problem is usually when they're replacing the CEO, not always, but usually it's when the company's in trouble.
That's right.
That's a double whammy, right? Because you have this transition problem and the company's in trouble.
Yeah.
That's why most of the time it fails.
Yeah.
But then you look at, you know, Google, where they...
Eric Schmidt.
Yeah, Eric Schmidt came in, but they weren't in trouble, and they got the buy-in from the founders.
Right. And it's a really good point, because, you know, to a certain extent, entrepreneurs, as we all do, have a hard time putting an X-ray machine up to your body and saying, what do I do well, and maybe where am I not quite as strong? And so, you know, there's this concept of professional management, which I'm not sure exactly what that means, but it's a concept, it's a term thrown around the industry of bringing in someone who's been there and done that. Then there are CEO coaches to try and help founders scale even further, things of that nature. But it's, and think about the transition we're seeing with Uber, right? For those transgressions and then all the churn, and their valuation probably dropping because of that transition that's occurring in a very public way. They're losing a lot of customers. Have any of you, are you taking Lyft more than Uber?
Yeah.
So am I, but think about the damage that's playing out, not only because of the ethics and morals, which is something that we should talk a lot about, because I think that's going to distinguish more of the winners and losers in the future. But the whole situation, the CEO transition and new management and everything else, and the board fight, which does happen. Boards fight, you just don't read about it too often. And it's many times one venture capitalist against another, which is happening in this situation, and it destroys value, right? And so that's the time where the CEO got to a very high level from a valuation standpoint, and then many people realized the company was hollow inside, but the huge growth hid a lot of the problems they had, which is really unfortunate given the strength, so many different strengths that Uber really has.
Okay, so I'll ask you another question. So my estimation of a great investor is not somebody who can invest and see the company shoot up, but when things get really tough for the company, that's when you know if it's a good investor. So are they sticking with the company? What do they do to help the company when things aren't going right? So I'm sure you've been in this position.
Oh, never.
So can you tell us a story about how you handled that situation as an investor, from the investor perspective, when things just weren't working out?
Okay, so I'll throw a lot of concepts in here also. Venture capitalists should be more than just capital suppliers. They should be resource providers. They should be network providers. They should be able to help you identify characteristics of especially senior managers that are needed in the company that aren't there today, and then actually go and hopefully find some people who might want to join. So it's an outside voice who has resources. So whether it's the organization that you work, that you run, executive staff, it's identifying great resources to bring to your companies. Because remember, a lot of things that the great thing about especially the Silicon Valley, but also other centers of excellence where founders are around the world, there's a whole bunch of bit players, right? Who come, they do a little something here, the attorneys, right? They know exactly what they're supposed to do here. You don't have to hire a full-time attorney. You just acquire their expertise for patents or some of the corporate work or whatever. So you get a lot of time slices of world experts in cities around the world which are known for entrepreneurship. Okay, so that's my vision, and a venture capitalist should be a sounding board for a CEO. Because being a CEO is a really lonely place. I mean, I'm sure you felt that in your career.
Oh yeah, especially if things get tough.
Yeah.
So tell us a story. Do you have a story to tell us?
So
I like stories.
I like stories too.
You don't have to say their real name.
I won't. No, I'll tell you the hardest thing for me personally is venture capitalists. You have a couple things you can do to really impact the trajectory of companies. One, which is a nuclear weapon, is to stop funding a company, especially when it's cash flow negative. Because when insiders step out, it's hard to raise outside capital. So you don't do that unless you're desperate to change something, and then you might be willing to take the risk. The other thing you can do if you're on the board of directors is to work to try and fire the CEO. Because that's, that's the only person who you have a fiduciary responsibility when you're representing all shareholders on a board, right? You're supposed to have the right CEO in there. That's also a really, really.
Did you ever have to
painful.
fire a CEO?
Oh, of course.
Okay.
And, the object, though, is not to walk in one day and say, you're really bad, you need to go, goodbye. That's not what you want to do. It's my preferred path by a factor of 100 is, Mr. or Mrs. CEO, there's areas which really aren't your strength. And in fact, it looks like you don't enjoy it much. Let's try and find some people who can help you. Then you don't have to worry about that area, right? And it might be bringing in some part-time people, eventually some full-time employees to help them, but you try and coach them. And if all else fails, and I've had to go through this, then it's, we need to make a change. And especially when companies are really small, it's really, really disruptive. You don't want to go there because the probability of success when you change CEOs at an early stage company, it's almost impossible to recover from that.
Yeah.
So,
Almost always fails.
yeah, the thing that makes me saddest is when I have to walk away from a company and say, I can't help you anymore. I can't, we agreed to X, Y, and Z happening. You knew that it had to happen in this time frame. We've spent an extra 6 months or a year trying to achieve that. We've made no progress. And I have a fiduciary responsibility to my investors. So let's go back to that. A venture capitalist raises money, especially good-sized funds. You go to institutions. You could go to endowments, university endowments. You could go to corporate pension funds. You could go to insurance companies, sometimes very wealthy individuals, but you raise capital. And you have a fiduciary responsibility when you manage money to do the best you can. And so if you continue to fund companies, then I'm breaking my fiduciary responsibility, which is a legal responsibility, to my investors. So if I did that a lot, I would be subject to litigation, to no support in the future, things like that. So you have to understand where venture capitalists are coming from, right? Small number of companies are going to really make the return. Fiduciary responsibilities to our investors. And so as you go into the venture community and raise capital, you have to understand them. Because the reality is they're a customer of your business. And it's critical you get involved with people, with venture capitalists who you can trust, who you think will have your backside protected. So one of the greatest things entrepreneurs do that I've seen, they'll ask me for references. Before you invest, could you please give me some of your CEO references? I want to talk to him. It's like, yeah, why doesn't everybody do that? Right? I mean, sometimes you think venture capitalists in the sky, thunderbolts, stuff like that. No, they're just regular people like you are. We're all in this together. And you need to reference them because they're going to reference you if you're one of the senior managers, right? Which goes back to what we look for. I actually will ask for some formal references for the senior management team, but then I'm going to triangulate through my own methods to find people who aren't formal references to give me insight into whatever senior managers are on the team. So there's part of it's in band, part of it's out of the band. But I'm going to do that. And I also suggest that entrepreneurs do that too, to reference venture capitalists, both CEOs, the names they're given, and then those maybe that aren't on the website anymore, but you can find your way to see them.
Yeah.
You know,
Especially the ones that aren't on the website.
right. But I'll tell you, I gained an appreciation early in my career, in the venture career, where I was with an organization, we were funding it in a massive way, and at some point it became greater than the 5 venture capital firms that were investing in it. It just was too expensive. They didn't make progress enough. The company eventually was shut down, and the CEO took his own life. That's what we're dealing with, right? It's like, oh my goodness, you know, that's, people live and die for their companies, right? That gentleman was all in, everything. Very seasoned person also, wasn't young, you know, 2/3 of the way through his career. But that, so when I think about companies and entrepreneurs, I just have such a warm spot, because I know, A, it's hard. I've seen a lot of companies struggle. Fortunately, I've seen some companies have really great success. But it's hard, and people take it seriously. And you're talking big money. So that's why venture capitalists who've been around for a while treat entrepreneurs with tremendous respect, because they know how hard it is. Definitely.
Great answer. So do you want to open up to questions from the audience?
Let me mention one more thing.
Okay.
How many of you have hardware associated with products or services that you're selling into the market? Okay, so I would say probably about 20%, and the rest of you software or services? Okay, so this is about understanding your customer being funding sources. You have to look and say, okay, Intel's been a big company for a long time, right? IBM was built primarily on hardware, and then software got into the mix, and services now is really what they sell. Venture capitalists really like software and services because you look at the gross margins. You look at the friction in building businesses. In hardware, it's hard to build a multi-billion-dollar company because the valuation multiples of revenue to sales much smaller than like a Salesforce or others. And so if you're thinking about building a company and you want to make it a family business or something like that, you don't really have to worry about that too much as far as this sort of multiple gap that I'm thinking of here. But if you want to build a company, you need to find areas that venture capitalists resonate with, and that's going to tend to be higher gross margin businesses, and it's going to be ones where there's not a lot of friction for buyers to find and utilize and buy certain solutions. So venture capitalists will bring a framework, and what you can do is, if you're going to start a company or you started a company, a lot of industry reports now that will profile where venture capital firms are investing. And in fact, what you can do, go to the venture capitalist websites, see what they've invested in. Because you want a targeted search for capital, and you want people, especially if you're early stage, you want venture capitalists who understand what you're doing. Have as many networks and resources to help you as you go through your company's life cycle.
They also may steer you in the wrong direction.
Definitely.
If they don't understand your business. Yeah, why don't we open it up?
Yeah, first a comment. I read somewhere a lot of your small business owners, because they worked so long in the business, when they're company failed, they killed themselves. The reason is that they have life insurance so that the money can go to their employee. That's a reason for that. I think the statistic in Italy, when they had a difficult time, a lot of small business owners killed themselves. But on your question, I've been running my company for 13 years. The biggest fear is to shut it down. It's a hardware company, lots of stuff. You may think about it's like killing your own baby because you create, you take care of the baby for those years. But then you have to shut it down in a very stressful, nightmare. So when you fire a CEO, let's say, the CEO should be relieved because now he has no responsibility. So who is going to take care?
You want somebody to fire you? Is that what you're saying? So you can walk away and say, hey,
actually,
it wasn't my fault.
That would be a relief.
Is that what you're
But the question for
we
you
have a
is like,
session
who
for
is
you
going to
starting at 9. Okay, there'll be CEOs who want to depart, but don't have an investor to work with you on that.
No,
who's going to take care of the business after you fire
so
CEO?
if your business apparently isn't growing, right?
Actually, it grew quite a bit of time for the
now it's going down. Hardware is really hard.
It's hard.
It's really hard right now because people can just copy it. It's very difficult. At a certain point, you just need to do it.
Sure.
You need to move on.
Oh, I did it already.
Okay, you did it.
Because I had this nightmare. Always, I say, okay, I'm going to shut down, to a different scale.
Yeah.
We return all the money to investors because we know the time will be
Yeah,
bad.
right.
So after a while, I become my own VC, to finance.
Yes, yeah.
Now everything is good because
you fired yourself.
Well, I couldn't because nobody replaced me. Especially how do you, let's say, finding a replacement CEO. It's very difficult because my position didn't pay salary for 13 years.
Yeah, who wants to work for free for your company for the next 13 years?
Not easy.
Yeah, it's really hard, right? Yeah, but it's good you did it because that.
Take care of your mental stress.
Right.
Yeah.
Yes.
But my question is.
So I'm going to ask a different question. And how many of you have a phone that has a biometric device on it? So most of you do. That was probably with all the ones here. That was a company that Apple eventually bought, and then Samsung and others had to develop their own technology. But that was another one of those companies where hardware company and you're sort of waves that are rolling. There we go. Waves that are rolling, but very difficult to predict, things of that nature. I mean, when you run a software as a service, you can smooth your revenue over an extended period of time, right? And so from a financial management standpoint, Wall Street loves that, right? And then all the hardware companies going like this. So we sold the company to Apple as a way to sort of exit our investment. It had gone public, but it's rolling those waves. And someone who could really embed it and drive the industry forward was the path that we chose. It was just a couple of years ago.
Okay, next question.
So actually, you pull up the hardware story. I thought it's really interesting because my technical background is coming from hardware, exactly in the sensor and actuator area. But later, after a few years in that area, then I have to leave because right now I'm a patent attorney. Because I don't feel like there are a lot of opportunity let me grow and become a small business owner or doing something by myself. So, but then you talk about the U.S. venture capitalist is more attracted to some kind of a software or service investment, right? But actually, my friends in China, they are kind of starting from the manufacturing business. Now they start to invest because they got so much money out of their early development. So then they will ask me, where can I find the hardware, like a small business in US, because we know you have better technology. Then really, I just don't know how to answer that question because there's some kind of gap here. It's because venture capitalists in US hasn't really been interested in this area. So there is no overall healthy environment for that kind of investment. But a lot of Chinese investors are really interested in because they have expertise and they came from that area. So I do see a gap there. I don't know whether it's a common and also Is there any
Yeah.
way to?
You know, it's a good comment. We see different fits and starts for hardware. If you look at autonomous driving vehicles, a lot of the technology is actually being developed here. And I mean, I started in the industry when we were investing in disk drives and CMOS fabs and, you know, bipolar, different types of semiconductor technology. But over time, the capital intensity of most hardware businesses, you know, GoPro, right, is headquartered close to here. They found they did well, but then at some point they started going up and down because you're selling something each quarter and it drives Wall Street crazy, right? So a lot of what we invest in, we're a reflection of the public markets, and they give you a tremendously higher value for more predictable businesses. And so I actually believe that's one of the reasons why, you know, we have all these business models in particular that have moved away from the license, right, where you charge one time, to the subscription model where I get paid each month, because it just really smooths out a lot of the issues from a revenue recognition standpoint. And you have even Oracle now, right, which is moving really hard into we want to do subscription businesses, we want to have cloud services, and away from your traditional, you know, buy it once and then buy it 3 years, you know, because it's really hard to manage that from, I'll say, a valuation standpoint.
So I'll give another perspective on this. So the reason, one of the other reasons, you were talking about public companies, but one of the other reasons even for startups, hardware is really hard, is because there is a lot of competition. So as soon as you come up with your hardware device, you can be pretty sure that somebody in Shenzhen who has a factory, like your friends, right, is looking at that. How can I produce it cheaply? How can I get it out there right now? I mean, they're on Kickstarter. Every time somebody puts up their hardware device or their IoT device, there's 24 other companies out there, or more, maybe 100, looking at how to copy it and just get it to market. Now the problem is, if you're first to market with like a cool new gadget, a smart device or some other hardware, you can make a lot of money really quickly, but then as soon as everybody else starts coming in, especially at a lower price, all your margins start to shrink, right? Because the only way they can beat you is by undercutting you in price. So you were saying it has to be a high margin business for venture capital. You have a high margin at the beginning, but the margins begin to go down and down and down, and then you're competing at their level, and then they're just, what they do is these guys run their own factories, right? As soon as the margins get too low, they're on Kickstarter again looking to copy somebody else, where they can get in and make some money, and they just keep repeating that process over and over of copying really quickly without all the investment in the initial R&D and the innovation, and that's how they keep their cash flow going. Now that's a different type of business, those the copycat factories, right. But for the entrepreneur, they're taking all the profit out of your business. Now the only way as an entrepreneur, if you're in hardware, to really lock in your customer, like get your customer, not just to pay you once for your gadget or your device, but to keep paying you money over and over and over again, is you have to have software in there. So you have to, so the value, like when venture capitalists now invest in hardware companies, they're not investing in the hardware. They're investing actually in the software, and the hardware is like a Trojan horse. Just get me the, if you, you can use this hardware to get me the customer, but you have a software platform that locks them in, that somebody else can't come in and copy and take them away, because they've invested a lot of time, a lot of data, a lot of other things that they can't just take over to a competitor, then your company starts to have value. If you look at the iPhone, right, Apple, well, their hardware isn't like that original. They, any Android device can, Samsung and all these others have as good hardware. It's the software that Apple is all about. And it's true across the board. It's the software and the ecosystem and how the customer engages and how you can lock them in and they get recurring revenue. So that is so if you're going to do hardware, make sure you have those components if you want to do a scalable big business.
Yeah, and So to build on
You're
Steve's
not
comment, no, but it's like, you know, GoPro now is trying to get into video services.
Yeah, but
and
see,
other
they
things.
never did it. They never made the transition.
Well, they're trying to.
Yeah, that's why they're
So doing that in the public markets when you're trying to transition your business model is like extremely hard, right? So they're running as fast as they can on the hardware side. Then they're trying to do market discovery on what is a service that other people will want to do. So they're making it cool by shooting videos and this and that. So there's some things they're doing which is getting some traction, but that's a lot different price point than selling a $450 camera with no accessories, right? And it's
And
just,
GoPro is really one of the few big hardware successes, right?
Yeah, totally.
Like
Well,
it was more the exception. They built a great brand.
Fitbit was
Yeah.
another. So there's a small number of companies who've been innovative, but then they kind of stopped there. They didn't say, hey, we're going to get cannibalized. And so they were so focused on just getting additional sales, they didn't know when the tide would turn. And then now they're struggling, right? All of them. And there's a huge number of hardware companies who've gone out of business that were startups funded by venture people, and a lot of money.
Like Pebble, they raised $10 million.
Yeah, I know. There's just story after story.
You have a question?
Yeah, it's coming at a slightly different angle.
Yeah.
So earlier you mentioned how these days more companies tend to get acquired than IPO.
Yeah.
That's been always true.
So that's the I don't have a long
Not anywhere.
experience.
Yeah, not anywhere close to it. You actually can get you can sell your company for $1 gazillion now, which was historically not the case 30 years ago, 20 years ago, 15 years ago. Now, many companies run a dual process when they're about to go public, and corporations know now that if they don't buy them before the company goes public, they'll have to pay 2 to 3x in 6 months.
So do you think that the trend towards more acquisitions than IPOs is generally better for entrepreneurs and VCs?
Well, 20 years ago, you could go public at a $100 million valuation. Okay, so the market, this is a long discussion, so I'll just touch on it briefly. Now you need at least a valuation of 500 million to $1 billion to go public. It's a lot higher bar, right? I mean, that's huge numbers. Think about the value creation. So I don't think we're going back to a world where there's as many IPOs or more IPOs than, successful exits by startups. And this is a really complex subject, but I just think most companies will continue to be sold. If it's small, it's hiring the employees at $1 million per engineer. If it's, that's something that big companies will do because they have a hard time hiring world-class engineers in general. And then as companies get more valuable, then the question is how much IP or how many customers do they have or whatever. The more traction you have, the higher valuation you'll see. The average company that's successful sells for like $50 million. So look at the data. It's surprisingly small, the number of companies that are valuable, hugely valuable.
Yeah, and then there are other options for going public. So if you're going to go on the NASDAQ or the New York Stock Exchange, you need a huge valuation. I know a lot of startups are going public like in Europe, on Sweden's markets. I know going public in Australia. Right. China has many different exchanges for different, they've set up all these different exchanges. So some where startups can go public very quickly in China. So there are many different options. And even under the Jobs Act, which has come out, you can actually go public for 50 million if you have, for 50 million or less, but not more. It's very strange. So there's some people running scams now, taking companies public at very, very low valuations on the New York Stock Exchange. It's crazy. So a lot of weird stuff is happening. But in general, like in the US, what David was talking about is the case. It's got to be big, and that's why people, that's why they tend to sell, is because they don't, Usually, if you know you can go public and get, have a good IPO, you're not going to sell, right? Because you can get 6x more in like 6 months. So you're just going to go public. You would only sell if you think you're not going to get out of the gate, and that's the best exit you could get.
Yeah, the other difference also is there's more liquidity options for employees. There's a very active secondary market. So part of the pressure used to be before employees couldn't get out unless the company sold itself or went public. Now, there's a lot of organizations, there's many funds, I know of multiple ones, who just want to buy employee shares that have already vested.
Well, the other thing, even more than employees, I would say, are the venture capitalists. Like, because you come to the end of a life of a fund, 10-year fund, these venture capitalists got to get their money out because they got to give it back to their investors. So they're going to pressure you to sell, at the end of the fund because they want their money. So even if you have some life left in you, then the venture capitalists may be saying, no, it's time. Let's sell this company, We're not going to wait another 5 years.
And I think if I read correctly, SoftBank's going to put $10 billion into Uber, of which only $1 billion is going to the company. The rest is going to
buy out other shareholders.
Yeah.
Earlier ones.
Venture capitalists.
Because they've been in there a long time.
employees.
Think about how long the early investors in Uber were in there.
Yeah.
They want to get their money out. It's a pretty high valuation.
Yeah. So that's probably the best recent illustration that's just happened in the last couple of
In
years.
China, that happens even more often. So a lot of investors in China, especially they have shorter funds, right? They have sometimes 3-year funds, 5-year funds, 7-year funds, not like here 10 or 12.
Right.
So a lot of investors in China will be looking to sell their shares along the way. It's very common.
Okay, other questions? This is a good group.
Other fun questions?
What do you think
Yeah.
about the blockchain?
Blockchain.
Oh, I have a lot of thoughts about that.
Yeah, the future of that. Because Chinese the government is regulate that. What do you see this will take off in American or in the world?
So I'm going to let him answer the question, but I think in Japan, they've kind of blessed blockchain for some sort of financial transactions. In the US, they're talking about regulating it now. And so regulations are very complex from sort of the money side. But blockchain is just not about money.
Yeah, so I know a lot about it. So in the US, it's not regulated right now. And what you want to differentiate on is the blockchain versus cryptocurrencies, because they're different. Now, blockchain, a lot of cryptocurrencies use the blockchain, but they don't have to. But they use it because it's a good way of managing cryptocurrencies. A decentralized system, the ledger system. But the blockchain itself is used for many different things. Yeah. So there are a lot of businesses using blockchain not to do these ICOs, initial coin offerings. But were you referring to the ICOs that were here in Bitcoin, Ethereum? Is that what you were talking about?
Yeah.
Okay, so I'll talk about that because there's many different applications of blockchain.
Yeah, do you suggest us to buy them? Like
Okay. I can answer that very easily. If you want to go to Vegas right now, you can go to Vegas and gamble your money, or you can buy those cryptocurrencies. It's pretty much the same thing. So you could get very rich at Vegas, and you could lose all your money. You could get very rich at buying these cryptocurrencies, or you can lose all your money. So it better be money that you can afford to lose. That's all I have to say. Right now, the value of Bitcoin, Ethereum are rising like crazy.
Yeah.
But 98% of their value is based on speculation. It's based on people buying in now because they believe more people are going to buy in after them, and it's going to go up. And all these new offerings that they're having with new cryptocurrencies or tokenizing all these different businesses, they're predicated on the same thing. Oh, people got so rich when they bought Bitcoin at a few cents, right? And now it's up to thousands of dollars. We should get in on these cryptocurrencies right now. So they're buying in. But already we're seeing cracks in the ICO market. So a lot of people become very rich. A lot of them are doubling down and they're becoming richer. but there's been some ICOs, like Tezos, which they ICO'd for $232 million, right? And they took that money and they basically had no plan. So they were this new company. They're like, oh, we're going to buy some gold with it. We're going to put it in stocks. And oh, yes, we'll put some of it into our platform. And they're being sued now because they went up and then now they're cratering, right? Bankcorp, another one that went up, now they're coming down. And people, so still Bitcoin is going strong because Bitcoin and Ethereum are kind of like the foundation layer. They're using these currency. Many of the other ICOs that are happening with new startups are using them as their kind of their basic currency. So people are converting Ethereum and Bitcoin into these new currencies or these new tokens in hopes of getting rich, and then they're gambling on those and selling them off. But it's a giant casino. And I highly recommend you only put in money. It's okay, if you were going to go to Vegas and just start gambling on the slot machines, it's that type of money, okay? If you're a real gambler, go for it. We'll see what happens. I, tend not to do that way. If I invest, and I think if David invests, we want to understand the core value they're offering. Because in the long run, these currencies, all of them will normalize to their real value. So once the speculative bubble kind of passes, right, bursts, they will still have value, some of them. Right? So some of them, like Bitcoin, will still have value. Some of them, like Ethereum, with their smart contracts, will still have value. But what their value is, we don't know. It's very hard to tell because, honestly, the amount of legitimate transactions being done besides speculation is still a very small percentage of what's happening, of the total currency being traded. Do you know anybody out here regularly buying stuff with Bitcoin or Ethereum? I don't know anybody, even the tech geeks, right, that love it. Your credit card is too easy. I get 3% back on my credit card. You know what? I don't have a big motivation to switch. That may happen in the future when it becomes a more mature ecosystem and there are more merchants using it and other transactions that require it. But it hasn't materialized yet. And until it does, that value is going to be low, but the speculative value is very high now. And that's a very simple summary of the blockchain.
Yeah,
in ICOs.
He's right on. And, you hear more about black market transactions and things of that nature, money laundering. I would wait till it settles.
Yeah, so the black market, we all know Silk Road and all those. Those are still not huge either, right? They made a big deal out of them, but those are still small.
They're in jail, too.
Yeah.
Steve, it's a very good analysis of a Bitcoin.
Yeah.
Now I'm asking you for the second most controversial investment, which is a Tesla stock. What do you think about it?
Oh my God!
I own a Tesla.
It's
beautiful.
You own the car.
But own the car.
You own their stock.
It's a hardware company.
No, I told my son when I bought my car, I got one of the first Model
And
S's.
you should have bought their stock
I
then.
said, we got to buy it. It was Christmas
You listened to your son?
2013. No, I told him. I said, we got to do this. I said, okay, we're in Christmas vacation. Came back. I forgot. It was $60.
Right. So Tesla's also risky, right?
Yeah.
Because everybody's moving into that market.
Yeah.
Now, Mercedes, BMW, every company is moving. GM, they're all Ford, they're all moving into electric cars. And if you look at the number of cars Tesla produces, it's a fraction of like GM or any of the big makers, big automakers. It's just a tiny fraction. They have to scale that. So they're overvalued right now, in my mind. They're very an innovative company. They're a very amazing company. But they have a lot to prove to get to to meet the valuation they have now. A lot to prove. Will Elon Musk be able to do it? He's a real amazing person, right? As an entrepreneur, I would always bet on him. But in Tesla, like if I had to invest right now, the answer is I would. There are probably other investments that are less risky. That's all I'm saying. It's a very high valuation.
Yeah.
For what they have to scale that business. It's hard to scale that business.
But the stock's not trading on a typical multiple.
It isn't.
And so you know, you either have faith or you don't.
Yeah,
Yeah.
if you're
Right.
you're an Elon Musk just believer, true believer, put your money in.
But
But it's like Steve Jobs, right? I mean, to bet on Steve Jobs when he took over the company the second time,
Yeah.
I mean, that was a crazy bet.
Sure.
But that guy just came through time
Sure.
and time again.
You mean Tesla? You know, if you look at both your presentation, everything you said is against Elon Musk. He's doing
Against?
too many, you know, like he's.
I'm a big fan of
Okay,
Elon.
of course. You see, there are a few things you said. First, he's doing too much. You know, he's having so many things in control. Second, he has a team that is not very stable. Then the hardware company is hard.
Well, you're making assumptions that I don't necessarily agree with.
Sure.
I mean, he changes his managers over time, but he is able to recruit
Amazing people.
A-plus managers. So he has gone through a transition with some managers over the last couple of years. But, you know, he's like the Warriors. They trade out one guy and they get someone even better from a management team standpoint, right? So as you go through your criteria here, let's have a dialogue. So you said he's doing a lot of things. Yeah, I think he's got huge bandwidth. So far, he's been able to be highly successful, right? He's digging under LA to put in the Hyperloop or other things.
Tunneling company,
Yeah,
boring company.
Boring company,
Yeah.
you know. So he does, but as long as he has excellent managers under him, he can paint the vision, he can help raise capital, and if he says, let's go take that hill to a certain team, they go and they do it. So he's a very unique person. It doesn't mean everything he's doing is going to be successful. Highly unlikely, everything. But he's doing a lot of things really well. He also has an advantage. And this is what most people don't realize. He can access capital at a lower cost than many of his competitors.
Right, because he's Elon Musk.
Yeah, same thing with Amazon,
Yeah.
right?
Yeah.
Amazon was a bookstore
Sure.
Yeah.
on the web. How did they build, you know, I don't know, what is it, 600 billion now is their market cap or some ginormous amount? It's so large my head hurts. But it's just awesome what they've done. Very few entrepreneurs can do more than one thing world class in their lifetime, right? He has an e-commerce platform.
Yeah.
He then bridged into cloud services, you know, and so he's
Now video.
he's going to many different areas. When he does something in the marketplace, he hurts all his competitors' valuations. Think about that. When have you ever heard of someone who says, oh, you know, we're going to go into whatever, and everybody's losing value and he's gaining value? You know, Amazon is gaining value. I just think it shows that for people who demonstrate outstanding results, especially in many areas, and as IT becomes the backbone of every single industry that is out there, he's in a great position to be the disruptor. And his cost of capital is also very low, right? Versus someone like GE, which is breaking apart expensive capital now because they have the same playbook that they developed 30 years ago, and they haven't changed it.
Yes, Elon Musk does some things very well. I mean, he is a great leader, right? So he's a great visionary. He's great at articulating his vision and inspiring his employees. He's great at pulling in capital, like you said. He's great at building teams. He doesn't worry about every detail of those companies. He builds kind of the team, and he lets them run, and then he starts something else, and he builds it up, and he promotes it, he gets all the press on it, and then he kind of lets it go, and then he's bouncing between these. So Jeff Bezos is doing the same thing, because if you look at Amazon, it's a bunch of different businesses. You know, the web services business, the e-commerce business, their Alexa voice business. They are relationships between them, but they're separate businesses, but he's doing the same thing. So these super CEOs, right, are able to do that. Most people aren't able to do that. They're lucky to do one thing really well. But if you are good at what they do, you can do it. You can pull it off.
Back in China, on the startup space,
Yeah.
you were talking about monetization using apps, selling ads. Is the consumer changing a little bit towards a subscription model? Do you see any monthly subscription model?
Well, the biggest monetization in China is not through ads. It's through transactions. So most of their apps monetize through payments or buying stuff, virtual goods, things like that. Advertising isn't, Facebook is an ad-driven company. Google is an ad-driven company, 85% of their revenue. Facebook, almost all their revenue. So those are really ad models actually much more popular in the West than in China. In China, people are buying stuff through their applications. A lot of the apps are powered by people buying these, they have this whole live casting system where they're buying these virtual goods and all the games where they're buying. That's the primary model in China right now.
And then for American companies, is the best way to launch an app there off a server in Hong Kong using like Alibaba's cloud system? It's pretty difficult to register, isn't it?
So if you're going to do business in China seriously, you're going to have to get set up in China with your company in China. Because being in Hong Kong still won't do it for you. You can start that way, but if you're going to get serious about actually doing business in China and everything, you just need to be in China.
Yeah, I was reading today about Amazon now with their web services in China. The government has forced them to sell their equipment to the local partner, to the Chinese partner. And so, at least the article said the IP doesn't have to be owned by the company. But the challenge is the government is very clever in how they set the rules, and they want pretty much everything to be in China. We can debate exactly.
They're going to make, as soon as you get any traction, as soon as you start get going, they're going to force you to be in China.
Right.
And that's just the policy of the government.
Right, and they probably want, if you use encryption or other things, that's a whole new layer, if you'll say, of complexity. It's hard for young companies, and I assume your company isn't large yet. It will be, I know. But at least right now, it's hard. Very few startups go for their first market or close second market to China. I had one company that went to China in 1995. It was way before the government officials started causing turbulence, maybe the right way to say. But we did learn, this was sort of an MMS service. The one thing we learned is overnight the government changed what we could charge, as well as everybody else. And so when you have those dynamics, we went and raised capital in China as opposed to doing it here, because we realized that the initial investors here didn't understand how to deal with that market. And this was prior to a lot of U.S. venture people going to China. And the reality is a lot of venture capitalists that are based here have left China and are going to India and other markets. But it's real difficult.
Well, there's plenty of capital in China.
There's a lot of capital.
So you can raise money in China, and you should.
Yeah.
Because Silicon Valley investors don't want to transfer their dollars into China because they can't get it back, right? They can't get it out of the country easily. So and there's plenty of RMB funds in China. So you're best off just raising your money in China. You're best off just setting up a company in China and figuring out the system. That's really, good question. Yeah?
One question. I know you mentioned China has a lot of money, and besides China, of course, there are other countries that are pouring money to the United States or the Silicon Valley.
Yeah.
Do you see more competition in terms of getting to the right or the best startups because there's so much money available from the VCs or investors?
China has driven up values in the U.S.
China, value or
the Tencent and Alibaba and these big companies coming in here and paying, and Chinese venture capitalists have been pushing up the value in Silicon Valley of startups, making it more competitive. to get in. So, because the valuations here are lower than they are in China. So the valuations of startups are higher in China, especially when the startup starts to take off. So the Chinese investors tend to be very conservative at the early stage. It's very hard to get angel funding right now in China. They want to wait till you start really going, and then once you're really going, man, the valuation just goes through the roof because there's so much capital there, and they're conservative that whenever they see something going, they all put money in it. So that's the dynamic in China. And then when those venture capitalists from China, those funds come over here, they see bargains, right? They see companies at lower valuations, and so they don't mind spending more because they're used to that at home.
But I want to pick up on another theme that you brought up. More than ever, we're seeing companies come to the Silicon Valley from around the world. It's unbelievable. And, you know, within 20 miles of here, you have more corporations coming from around the world to set up their labs, to collaborate with startups. And so this is the meeting area of the world. And that's where Founderspace is like so impactful, because the organization has relationships around the world, and the best entrepreneurs to build big companies know they have to come here or Beijing or somewhere in China. There's two places you can build billion-dollar companies, either here, right, by tapping into the resources, or tapping into the great resources in China.
Yeah, China's a great market. But yeah, it was a good question. I think Silicon Valley is still the best marketplace in the world for global startups. It's